What's up guys, it's Paul here for the 95 Investors Club channel. In this video I'm going to show you exactly how to set up stop losses for your options trades, as well as how to adjust your debit or credit spreads to either minimize losses or even in certain cases maximize your profits. Okay, so first, right off the bat, I want to talk to you about stop losses. Here I have ARK Invest ARKK $110 call for December 18th. I have 6 of the contracts at an average cost of 193, and I'm actually down 9% as of now. So let's say I want to set up a stop loss in such a way that I don't want to lose more than 15%. I want to cut off my losses right there and avoid any further downside. What I would do is 15%, let's say, is around 165. So first you would hit sell to close, click on stop limit order. The stop price is the ask price at which the limit sell will get triggered. Okay, so if you set the stop price as 175, which it's showing at right now, which is the current price, it will get triggered immediately because the ask price is already above the stop price. So you want to set up a stop price in such a way that it's actually below even the bid price. Okay, so that way it won't get triggered immediately. So for example, just to show you how that works, let's say I set it up as is. I set the stop price at 175, which is what it's trading at. I want the limit price to be 175. I click on review order. It's going to tell me that the stop price is high, which means that it can trigger immediately, and it might sell off right here. Okay, so what you actually want to do is you want to set it up below your bid price, so 165 for example, and set your limit price to say 170. That way what will happen is if the ask price drops from 180 to 165, it will immediately set up a limit order to $170 so that all your contracts get sold off at 170. Okay, so the reason you wanted to set it below your price is so that, let's say it never comes to 165, let's say the ask price drops from 180 to 175, 170, but never actually comes to 165 and it starts shooting back up, then it actually helps you from getting out of a trade before it starts shooting back up. Okay, so if you set it too close, it may sell off right away, and before you know it, the ARK might keep shooting it back up, and this could be a $2, $250, or $300, and you would have just lost out on all those gains. Okay, that's why it's important to set up your stop losses below the ask price so that it doesn't get triggered immediately. Okay, now that is how you use stop losses to minimize or cut off your losses. Okay, now here's how you would use a stop loss to actually lock in profits instead of cut off losses. Okay, so in this case I have the 105 call here, which is actually up 30%. So let's say let's say I forgot about this call and ARK started dropping back to my break even, and I started coming down. That would mean that I actually missed out on at least this 30% gain. So to avoid that, let's say I want to set up a stop loss such that I wanted to lock in at least 25% profit. What I would do in this case is sell to close, again stop limit order. In this case, I would set the stop price at least 25%, which is, let's say, around 365, just for simplicity, because you want it to be below 370. Okay, in reality 25% is more like 375, but like I said, you want it to be below the bid price at least so that it doesn't get triggered immediately. Okay, so I'm setting the stop price at 365. I want the limit price to be 370, for example, which is closer to that 25% that we were shooting for. You want to sell 3 of the contracts. Click on review order, and that's exactly what it's saying. As soon as the ask price reaches 365, your order will be converted to a limit order or a limit sell at a price of 370. Okay, then you will hit submit and it will go through automatically as soon as the ask price drops to 365. Now what this shows you is that if you made a good amount of profit, it's always good to set up a stop loss, or in this case lock profits, I would say, so that you would actually at least lock in 25% profit if it started going down. Okay, if you look at the history of it, there was a time when it shot up to 845, so that was already a 3x on my almost a 3x on my calls, and I forgot to set up the stop loss because when it was at 845, I could have easily set up a stop loss for 800, for example, so that at least on its way down, it could have sold out at 800, and I would have locked in at least a 250% profit. Okay, so this is something you can try. I haven't tried it a whole lot myself, but it's a very interesting strategy as opposed to a stop loss. In my opinion, I like calling this a lock profit because you're at least locking in a certain percentage of profit that you would like. Okay, so having talked about stop losses to cut off your losses, as well as locking profits on options that you were already up on, here's how you would adjust your credit and debit spreads depending on how it's working out for you. Okay, so here for Apple, I have this 117, 118 call debit spreads. My average cost was $50. Because Apple dropped a decent amount on Friday, I just broke even on it. The way debit spreads work, as you already know, is you need the stock to stay above the short call, which is the $118 call. Since Apple is at 117.15 right now, this would mean that if it falls below 117 by expiration, this debit spread would expire worthless and I would lose my entire $750 initial investment. So what I would do to adjust it, for example, is I would go to view all options, choose the expiration date, which is November 27th, and I could push it lower. So the way I would do that is I would buy back the 118 call, sell the 117 call, and let's say I expect it to stay above 115. I would sell the 115 call and buy the 114 call, and it would cost me about $30. Okay, so remember, my initial cost was $50. If I do this adjustment, my net cost would be $80. And if Apple can stay above 115 by November 27th, my net profit would only be $20 instead of $50 if it had stayed above 118. Okay, that's one way to adjust the debit spread. Here's another way you can do it. The second way to adjust your debit spread is to roll it over to a different expiration date, where you would buy back your 118 call, sell the 117 call that you bought, and go to another week, a 1 week or 2 week, depending on what you want. Say you go to December 4th, and you could potentially buy the same spread. You could sell the 118 call, you could buy the 117 call, and this would actually, they're actually priced in such a way right now that you may actually get a credit. But there, you can see that there is a bit of a bid-ask spread. So I have 15 of these spreads. So a limit price, I could set it at 0.05. So I could actually get a credit of $75 to roll it over to December 4th. Okay, so that's one way you can do, so that you're actually giving Apple more time to recover from 117 to at least 118 by December 4th instead of November 27th, so that you can still make a profit. Okay, in fact, in this case, you're getting a higher profit because your initial cost actually reduced from $50 per debit spread to now actually $45. So now your net profit can be $55 instead of just $50 by rolling it over by one more week. Okay, so this is how you can limit your exposure to risk for debit spreads. For credit spreads, on the other hand, here I have a credit spread on Roku. Because Roku shot up almost 3% on Friday, I'm actually down 37% on this credit spread. Now, as you know, credit spreads will expire worthless as long as it stays below your short call, which is the 270 call in this case. So let's say I want to adjust my risk on this. Same thing, I have two options. I could either choose to, buy back the 270 call, sell the 275 call, and push it up $10, for example. So I could sell the 285 call and buy the 290 call, and that would cost me $76 per credit spread to adjust it. Or I could roll it over similar to the debit spread, where instead of November 27th, I could choose December 4th, for example, and do the same process where now I'm actually buying the 285 call again, or 290 call, like in the previous example, and sell the 285 call. And this is costing me only $45 instead of $76 that we saw in the previous case. Okay, so those are the two ideas that you can have, guys. You can roll it over to the next week, or you can adjust it to the same expiration at a lower or higher strike price, just depending on how whether it's a call spread or a put spread. Okay, I hope that helps you guys out. If that was confusing, please leave a comment below. I'll clarify it as much as I can. If you're on my Discord, feel free to ask questions there as well. I try to help you out as much as I can. But if you enjoyed it, if you found this helpful, please do smash that like button. Leave any comment below if you have any other questions. And be sure to subscribe if you haven't already and hit that notification bell, okay? Thanks again for watching, and until next time.